Hey guys, welcome to DevTech Finance. In this video, we would be learning about the term called futures. So you often have heard this term futures in derivative market. So while you are trading in derivatives in stock market, you must have heard about this futures term. So what exactly a future is? So a futures is a contract for buying or selling a specific underlying asset on a future date at a price specified today and entered into through a formal mechanism on an exchange. So this trading is done, of course, on exchange as trading in shares are done. So in the same way, the derivatives trading happens on exchange. Here, what happens is that you make predictions about the future prices of a particular share, and to cover up the risk, you try to make contract at a present period of time. So let's understand this with an example. For example, share price of a particular stock is rupees 60. Now you as an investor feels that in future course of time the share price of this company may go high to rupees 100. So you make a contract at present period of time that on future you would be buying this share at rupees 60 only. So you come into this contract. Now what happens is that even if the prices of this particular stock tend to go to rupees 100, you won't be worried because you would be getting that share at rupees 60 only, because already you have come into a contract at rupees 60 for a future period of time. Now what happens is there is risk in it also. So if the share price would come down to rupees 40, you would be incurring loss. So you have just made a prediction that maybe in future the prices would go high to rupees 100. So it's better that I make a contract at rupees 60 on a future date at the present period of time. So I would be buying at rupees 60 only even after 1 month. So whether the share prices would go, if the share price would go down, you would be incurring loss because you may have purchased at a lower price. But if it would be going high, you would be in profit because you have purchased at a lower price. So this is how futures work in derivative market. The terms of the contract, such as order size, contract date, delivery value, and expiry date, are specified by the exchange. So, whenever you come into future contract, you get all those informations like the order size, how much quantity you have made in that contract for buying that particular derivative in future period of time. So, the quantity of stocks, contract date when you have formed the contract, then when you would be when there would be the delivery value, what would be the delivery value. So at the future course of time when you want to purchase that asset, or it maybe you want to sell that asset, both the ways. So what would be the total delivery value and what would be the expiry date of that contract, all these would be specified by the exchange and in the contract which you would come in by buying futures in derivative market. A futures contract can be bought or sold on the exchange in the derivative segment of the market. I already mentioned that. The price of the futures contract moves based on trades just as it does in the cash or spot market for stocks. So the prices of future is also determined by the demand by the buy and sell figures of the that particular derivative, that particular stock, and it moves in the same pattern as we observe in shares or spot market. So there's no difference. The market fluctuations is the same, and the price determination is according to the buy and sell, the transactions, the trading happening in that particular stock. So thank you for watching. Do like and share my videos. Subscribe to my channel DevTech Finance. Thank you all.